Yes, hello everyone, and thank you for joining, and welcome to the Landis 2021 Grain Market Outlook webinar. My name is Andrea Taney, and I am the Manager of Marketing here at Landis. Before we jump into the information being shared today, I wanted to share just a few reminders. All attendees will be muted throughout the webinar, so if you do have any questions throughout, please submit them through the chat function. Our moderators will be taking a look at that, and we'll share them at the end to be answered. This webinar also is being recorded, and we will send out the recording to all attendees afterwards, as well as share on the Landis social channel. So make sure to look for that if you are wanting to watch again. So with me today to present is Jake Moline with StoneX Financial. Jake is a risk management consultant based out of West Des Moines and works primarily with commercial hedgers, from grain elevators and cooperatives to commercial livestock producers and ethanol plants to manage risk and maximize margins. Today, Jake will be providing insights to current grain market fundamentals with a focus on the March WASDE report that came out yesterday. He will also be looking into what is in store for the grain markets for the remainder of the year and beyond, as well as walking through some grain marketing strategies offered at Landis to help you take advantage of opportunities and protect your risk. So with that, I will pass it over to Jake to get us started.
Thank you very much, and thank you all for joining me here today virtually. It's a little odd doing grain market outlook meetings this year all virtually. Usually people don't laugh at my jokes in person meetings, but when there's nobody on the other end here, it's a little awkward at times, but appreciate it. Hopefully next year we're back to doing in-person meetings. As Andrea explained, I am my goal here today essentially is to give you guys a little bit of insight on what's going on in the market, as well as kind of a recap of what happened in 2020, what we're looking at in terms of a market structure today, and also a little bit of a preview on some of the different possibilities that we could be facing for this next growing year. There's my disclaimer. You guys all had time to read that. Good deal. So let's review 2020 first, and thank God it is, in hindsight, literally not my favorite year, and I'm sure it wasn't your guys' either. It was frustrating for a variety of reasons, including, but not limited to, all of these little bullet points here. So if we rewind to about a year ago, at that time, we could not have been in a more different fundamental situation when it comes to the corn and soybean markets. We were dealing with African swine fever that was rampant at that point, a trade war that we did make a deal, I believe, on January 15th of 2020, but high trade war tensions at that point that was pressuring corn and soybean markets. COVID-19 kind of officially really became a big thing around this time last year. Made the trade deal, obviously. We had some lockdowns and a downturn in demand, and most notably, when it pertains to corn and soybeans, a downturn in demand for gasoline and hence ethanol, and hence corn demand for ethanol. We had a good planning and early weather spring season, I would say, throughout most of the Midwest. And at that point in time, the USDA was projecting massive production and massive carryouts for the past growing season. Then it turned dry, and that dryness gradually turned into a drought across many parts of the Midwest and obviously Iowa. We all learned a new vocab word, at least I did, in August of last year. I still don't know if I'm pronouncing it correctly, but we had a derecho to deal with. USDA started to lower production around that time, and as we moved into the fall, WASDE reports, and they also revised stocks lower in some of the quarterly stocks reports. That's become kind of a habit of theirs that's also extremely frustrating. Chinese demand started to pick up around that same time, and ASF kind of, I would say, China has recovered from ASF at a much quicker rate than everyone was expecting, and their demand has picked up with it. We're going to chat a little bit more about ASF later on in the presentation, but it is starting to make a little bit of a resurgence in China. We had a dry and slow start to planting in South America, and Chinese demand really was what drove the market from the fall timeframe throughout this winter, and it continues to be the driving force behind the need to ration demand and have higher prices. So we've pretty much done a complete 180 from this point last year. I always like to begin a presentation kind of reviewing some more long-term price history charts. So this here is the nearby corn price all the way back to the early 2000s. And you can see at the beginning of this chart that back in the early 2000s, when we were in a comfortable supply-demand situation, prices were confined between about $1.70 and $3.20. And then starting in 2006, we shifted that oversupply area higher, and it was a huge new demand base called ethanol that was introduced through the RFS at that time that kind of caused that paradigm shift in prices higher. And I would say that when carryouts and carryout to use ratios are comfortable here domestically, now prices tend to be confined within a dollar range between $3.20 and $4.30. You can see that at the beginning of 2020 and throughout most of 2020, we were at the bottom end of that oversupply area. And late this last summer and into the fall time frame, and then throughout the winter, we gradually and rapidly, I would say actually is a more appropriate word, moved our way up towards the top end of that, and now we're in what I would call the demand rationing area. When we take carryout and carryout to use below a certain point domestically, the job of price is to rally to slow down demand so that we don't run out, and we are currently doing that. Same thing in soybeans. We don't have ethanol to point at in terms of what caused the shift higher in prices, but I would say it's more attributed to global demand for protein and diets changing throughout the world, and that's a trend that I don't see slowing down at all anytime soon. So I do think protein demand globally is going to continue to increase over the coming years, and it may be more common to see more and more bean acres planted and fewer corn acres, to be honest with you, especially if you look long term and at electric vehicles and kind of the future of ethanol. But yeah, we were at the bottom end of that oversupply area. It was about a $2 range between $8.50 and $10.50, and we are smack dab in the middle of the demand rationing area. The takeaways that I like you to have from these two slides here are basically, when we enter into demand rationing area, volatility picks up, okay? And that's really the only guarantee I can give you throughout today's presentation. I'm not going to be able to tell you where prices are headed, but I can tell you that I expect volatility to remain very, very high throughout this summer. And what I mean by volatility is, the change in prices and potential price ranges are much wider when we get into these tight situations. You're looking at a $7 price range there in the demand rationing area for soybeans, and you're looking at a $4 price range in the demand rationing area for corn, as opposed to the dollar range that you see in the oversupply area. So the only guarantee, honestly, is uncertainty and volatility. Just a little review of some of the outside markets here before we get into the fundamentals. The dollar was under pressure for a majority of 2020. It's recently started to rebound a little bit here, but that's definitely been a supportive factor to commodity prices. It makes us more competitive on a global scale, helps us export more products out of the U.S., and that has been a supportive factor to the grain markets up to this point. When you look at interest rates, this is a really hot topic at the moment. Interest rates are starting to tick a little bit higher, not the Federal Reserve's interest rate, but predictions about interest rates in the future, and the interest rate curve is steepening. There's more carry being built into what traders think interest rates are going to be 10, 20, 30 years down the road. If you look at the right chart here, it shows interest rates, the 10-year Treasury yield all the way back into I think the 1960s. I wasn't around during the 1980s, but many of you I'm sure were, and you can see that since that time we've seen just a steady decline in interest rates down to record low levels. And just recently here, I would say talk about inflation and the potential for rising interest rates has gained a lot of traction. And when we talk about inflation, one of the hedges that hedge funds or traders or money managers use to protect against inflation is to buy commodities as a store of value. And you can see here that the total value of a major commodity sector is based on, I think, the year 2000 here. We've seen a massive rebound in all commodity prices. After seeing a ton of pressure when COVID became a thing, we had negative crude oil prices and all that fun stuff to think back on this past year. But grain prices have also been seeing a ton of support, not just corn and soybeans. You're dealing with tight supply situations across a lot of different commodities at the moment. And when you have people using the word reflation or inflation almost every day here recently, and the type of stimulus package that I think is going to be passed by the House today and signed by President Biden here soon, I believe we've had $4 trillion in COVID relief passed thus far. I've got another 1.9 trillion moving through Congress at the moment. When you pump that much money into the economy, people are going to spend it. The people, majority of people will spend that money. Some will invest it, and you've seen support evident in equities, and especially stocks that catch the interest of kind of young millennial type retail traders here. But a majority of people are going to spend that money. And when they spend it on stuff, it increases the demand for that stuff, and prices move higher. And that's kind of how inflation works. And I just say it's going to be something that we're watching. It's a big, I wouldn't say we're in a super commodity boom cycle yet, but it's definitely something to watch and something to think about when it comes to your farm operation as well. Farm operations are usually pretty heavily leveraged businesses and have a lot of risk of interest rates rising and affecting the bottom line. So definitely I would encourage you to be having discussions with your banker or whoever's your lender about locking in interest rates potentially long term. Let's look at market structure here a little bit. So this chart here shows the general makeup of the two major position holders in the corn market, and that is the producer merchandiser category in the red line here, and then the managed money or fund position in the green. And then you've got the yellow line displaying spot futures prices, and this goes all the way back into 2006. I think it's very important as a hedger and as a producer for you to understand and be aware of the cards the opponent you're playing poker with is holding. And at the moment, the managed money position sits near a record net long. They hold a net long of 348,000 contracts at the moment. And the producer merchandiser holds a net short of 730,000 contracts at the moment. Near a record. And we put in a record just a couple months ago on that. Certainly doesn't feel that way to me across most of my commercial customers. I would say corn ownership throughout Iowa is getting tighter by the day, and I don't feel like there's a ton of commercially owned corn throughout Iowa. There must be in other parts of the Midwest. But as you guys know, a lot of you forward sold corn this past year and sold corn this past harvest and did so throughout the winter and rewarded the market. And I realize, a lot of you are probably experiencing seller's remorse. It's just a natural human emotion to see. But we definitely saw really, really heavy farmer movement during the fall timeframe and post-fall that helped this net short position in the producer merchandiser category grow to a record level. So what does this mean, and why does it matter? Well, when the funds decide to start to trim down their net long position, they can do that at a pretty rapid pace. The pace at which the producer merchandiser net short decreases tends to match the natural consumption pattern of corn throughout the marketing year. And corn's a pretty steady flow, I would say. In fact, probably has stronger demand during the back half of the marketing year where we see export inspections pick up. but it's pretty steady throughout the marketing year. So as corn gets ground for feed or ethanol or exported out of the U.S., those short positions that are being held by the producer or merchandiser are offset, and that position decreases. And it's going to happen at a pretty consistent pace as we work throughout the summer here. The risk is that the funds decide to lower their position and sell out of long positions at a faster rate than the natural consumption occurs by the producer merchandiser, thus potentially putting downward pressure on prices if they decide to sell at a faster clip than the producer merchandiser buys. So whenever the funds hold a long position of this size, near record, I view that as somewhat of a liability to prices for bulls. So just keep an eye on that. Right now, the funds are long a lot of different commodities, and I don't see that changing with the whole inflation rhetoric that's taking place at the moment, but things can change unexpectedly, and just keep a close eye on that. Same thing in soybeans. Really, it's the same story. However, we've started to see the funds and the producer merchandiser trim those positions at a little faster clip than we've seen in corn thus far. And that's because soybeans are typically much more front-loaded in terms of demand throughout the marketing year. We sell and ship soybeans during the first half of the marketing year, and then around this time exactly is when Brazil starts to take over, and our exports virtually, shut off throughout most of the summer. So I would say, that trimming down of the net short held by the producer merchandiser is probably going to slow up a little bit here, and just something to watch. The funds are near a record net long there as well. So where are we today? We did have a crop report out tomorrow. You might not have known it yesterday. It was a pretty boring report as expected. We're obviously seeing a negative reaction today. As we look at some of the numbers from yesterday, this is the ending stocks figures here in the red. You can see that they were all completely unchanged versus the previous USDA estimate in February. So we don't have a whole lot to talk about in terms of changes there. I did notice there was a 1 million bushel shift from, I think it was seed to residual demand in the soybean balance sheet, so they did do something. But carryouts were left unchanged at very, very tight levels, as I would note. The average trade estimate was looking for a slight cut to corn and soybean carryouts yesterday. About a 30 million bushel decrease to corn carryout was expected. A very minor 3 million bushel decrease to the soybean carryout was expected. But I would say nothing about yesterday was surprising to me and probably most traders. And today's pressure is probably more a result of the fact that you need to continue to feed the bull every day in order to sustain rallies like this. And it's not uncommon to take a breather, have a correction. I don't think anything major in yesterday's WASDE report is really something you would point your finger at as a reason for today's pressure. We did see South American production numbers, which is probably the more important thing to focus on from yesterday's report and what traders were more closely watching. They did not touch the corn production estimates in either Argentina or Brazil. The soybean estimate in Argentina was taken down, I think, 500,000 metric ton, and the Brazilian soybean estimate was increased a full million metric ton. So not a lot of big changes made there. As you look at the average trade estimate here, they were calling for a slight cut to both Argentine and Brazilian corn production. Didn't see that. We were expecting a slight increase in Brazilian soybean production. It ended up being a little larger than expected, and the Argentine soybean production number came in as expected. I would say in future months, we're going to be watching, crop conditions in Argentina, where it's been fairly dry, harvest progress and corn planting, the second crop that follows that. In Brazil, it's been too wet in many local areas of Brazil, and it's potentially going to affect the quality of the soybean crop and the planting pace of the second corn crop. So we could see some revisions lower as a result. As we look at global ending stocks from yesterday, corn and soybean global ending stocks came in above expectations, I think mainly because South American production estimates came in above expectations. But I wouldn't say that anything is super jarring about these numbers from yesterday. A lot of numbers here on this balance sheet slide. I just want to kind of show the progression from December to January to February to March of what the balance sheets have looked like. The big report obviously was the January crop report. You get a lot of data in January. You get final production numbers, you get stocks numbers, and you get all that stuff baked into the balance sheet as well. One of the surprises that we saw in January was a revision lower to the 1920 carryout in corn. They brought that down to 1.91 billion, thus decreasing our carry-in number. The big surprise, however, was the yield number. Dropped to 172 from 175.8 in December. Big drops in states like Iowa. They did decrease demand in that report as well. I think primarily because they didn't want to print a carryout lower than 1.55 at that point. And I would say the decrease in ethanol demand is warranted. The feed and export demand figures, however, were probably not warranted at that point. And you saw in February them go back and increase export demand a little bit on corn, and thus drop our carryout down to 1.5 billion, where it sits today, with a carryout to use ratio of 10.27%. USDA is expecting the average farm price in this current crop year to be $4.30. So that's a cash price that they're projecting there. And you can see that absolutely no changes were made to the March balance sheet on the far right here. And one of my favorite ways to evaluate whether a market is fairly priced or at equilibrium price is to look at carryout to use versus price. So this chart shows all the way back to 2006, all the March WASDs back to 2006, where the carryout to use ratio was estimated at that point versus where the spot futures price settled on that day. And you can see that 2021, with the carryout to use just above 10%, is probably fairly priced right around $5 on the board. So some of the pressure that we've seen since the February crop report, where we had the same carryout to use ratio, we had a slightly higher price at that point, I think is warranted. I think there's a premium built into the market because of issues that are non-domestic. You have production issues in Ukraine and South America, and delayed harvest and delayed corn planting, all of that stuff being baked into this price as well. So there's other factors that play into it, but it is a fairly high correlation. And I would say that corn prices, at least the spot price, is just slightly overvalued at the moment. As we look at the soybean balance sheet, again, no changes in the March WASD. They did shift some residual seed number, 1 million bushel around, but that's not evident in this table. In the January crop report, they took yield down half a bushel per acre to 50.2. That was a little bit jarring as well. But we kind of saw this coming, and I would say that the drop from 175 down to 140 and now down to 120 as they increased the export figure in February. This is about as tight as a carryout gets, and it's probably about as tight as the USDA wants to publish on the balance sheet, especially this early in the crop year. We're at a record low carryout for this early in the crop year. And carryout to use at 2.62% is extremely low. The USDA is currently projecting an average farm price of $11.15 per bushel. As you can see, no changes to the March WASD, but as we look at that carryout to use ratio plugged into our carryout to use versus price chart, you can see that the relationship between carryout to use and price tends to get more parabolic or exponential as we get tighter, and prices need to rally at a higher rate to slow down demand in soybeans than they do in corn. Also, there's a little bit less of a correlation here. You can barely see the R squared up there, but it's a little lower than the corn relationship. And that's because we export a larger percentage of our soybean production, and global factors tend to affect soybean prices a little more than we see in corn. But with where soybean prices settled yesterday, I would almost say that they're a little bit undervalued relative to how tight we are at this point. We really, truly have no margin for error on the soybean balance sheet this year. And just to illustrate kind of how frustrating 2020 was, if you look at the changes from the production estimates published by the USDA in August versus where they were in January, the USDA lowered corn production over 1 billion bushels from August to January, and they lowered soybean production almost 290 million bushels from August to January. And those are both record changes as we look back throughout history. And they've done a similar thing with carryout. If you look back to where the initial carryout estimate was, and the first month that they released that new crop carryout estimate is in May for 2021, it was at 3.3 billion bushels in corn. And you can see as we've moved throughout the crop year here, currently at 1.5 billion, we're less than half of that at the moment, unchanged versus last month. On the soybean side of things, we started the year out, they were projecting a 400 million bushel carryout for this year, and it grew all the way up to 600 million bushels in August, before dropping all the way down to 120 million bushels currently. So it's been a frustrating ride for grain marketers and people who forward market grain. I will be the first to acknowledge that. It's extremely frustrating for you guys and as you're trying to develop marketing plans. But I would try not to let the pain and seller's remorse that is fresh in your mind from this previous year affect your marketing habits in the years to come, because we saw that happen in 2012. And if you went through that, the importance of kind of sticking to a plan in the years following a tight year like this. Let's review some of the demand side of things here. So ethanol demand starting to pick back up a little bit here. This is a chart of the spot ethanol margin for a typical Iowa plant. You can see that throughout a majority of the latter part of 2020, as we moved into 2021, ethanol margins have been very poor. And it's kind of been a result of gasoline demand running below normal, I would say. We've seen enough ethanol production come offline and plants running at about 80-82% of capacity here for long enough that we started to draw down ethanol stocks enough to where margins have come back, and they're actually positive at the moment for the first time in a very, very long time. So I do think you're going to start to see corn demand for ethanol pick back up a little bit here. You might see that reflected in basis even locally in Iowa. I know there's still a few plants that are down in Iowa, and I've heard rumors that there's a few that are going to be coming online here soon. If you look at the margin opportunities that ethanol plants are facing today, this is the first time we've seen positive margins really in the spot, or they've had some positive margin in Q4, I would say, for a little bit, but ethanol plants have gone a long time without seeing this type of margin opportunity. So they're going to start to pick production back up, and as you know, it's kind of cyclical. Eventually, we'll probably see some overproduction and stocks rise, and then pressure on price and margin will start to dissipate and maybe even turn negative again at some point. But driving demand is starting to pick up a little bit. This chart shows the weekly gasoline demand, and it's been very common. You can see the dip here a couple weeks ago. That was caused by the cold snap that we saw across most of the Midwest and middle part of the country, reducing driving demand. But I would say on average throughout 2020 and the first part of 2021 here, we've been at least, I would say, 10% below normal gasoline consumption on a weekly basis, which is a big deal for ethanol and corn demand for ethanol. This last week, I think we jumped up to only 8% below normal, which I think might be the best number we've seen for some time. So hopefully as vaccinations pick up and people start driving back into work a little bit more, there might be some habits that long term have shifted here. So I don't know that gasoline demand will ever truly return to what we quote unquote call normal. And a longer term pattern that we need to be cognizant of and watching is the electric vehicles becoming more and more popular and the push towards those. But I would say in general, the past couple of weeks have been a positive thing here when we look at gasoline demand. This number just came out this morning. When we look at the demand side on exports, this is really where a lot of the focus is in the market at the moment. On the top here, you have export sales progress in the top two charts, and on the bottom, you have export inspections progress. There is a difference between the two, and it's important to note that just because a sale is made does not mean that that bushel of corn actually gets put on a boat and shipped overseas. So when the bushel actually leaves the country, it's called a shipment or an inspection, and that's the numbers you'll see on the bottom chart there. Cumulative corn sales to date here, and you'll notice that a little over a month ago we had a massive sales week, and it was very, very common throughout most of the winter, I would say, to see large flash sales announced on an almost daily basis, and those have shut off here. We haven't seen I think we had one flash sale to Japan a week ago, but other than that, it's been really since about a month ago that we saw the last flash sale. And export sales have really, really dropped off here as of late. But cumulative corn sales are sitting at about 2.3 billion bushels, which is 90% of the USDA's current estimate. So they're a good 590 million bushels, or 23% ahead of pace. What isn't ahead of pace are cumulative corn shipments. They are only just right on pace, right around a billion bushels, or 42% of the USDA's estimate. The difference between the two is what I would call unshipped sales, or sales that are at risk of cancellation. And you're sitting with about 1.2 billion bushels in unshipped sales at the moment. You can see here on the bottom right chart that corn shipments actually tend to be more favorable in the summer months, which is kind of the opposite of soybeans. So you can see that we've been running well ahead of average throughout this whole marketing year, and we're going to need to just kind of continue that above average pace throughout the summer time frame in order to achieve that export number. I don't see any reason at the moment why that it wouldn't be the case, especially with some of the issues that are taking place with the Argentine corn crop and delayed Brazilian planting of their safrinha crop. So expect these numbers to kind of continue to be the same on the balance sheet. There might be a potential for the USDA to go ahead and increase corn exports sometime this summer, I think. As we look at the same thing for soybeans, you can see that cumulative bean sales sit at 2.21 billion bushels, 98% of the USDA's current annual estimate, way ahead of pace, 17% ahead of pace, and shipments are actually also 17% ahead of pace, just below 2 billion. There's about 278 million bushels, but difference between the sales on the books and the amount of beans that we've shipped thus far. Again, those are unshipped sales, or sales that are at risk of cancellation. We haven't seen any major cancellations yet, and it doesn't seem like that's likely with all the harvest issues that are occurring in Brazil at the moment. But you can see that throughout the summer months, we tend to see very, very small net sales made on the bean side of things, and shipments really virtually shut off until we get really into the July-August timeframe, where they sometimes pick back up. But yeah, I would say the USDA could make a case potentially to increase exports at some point on the balance sheet. I think if they do that, they're also going to increase imports, though. I just don't see them wanting to print a carryout number that's much lower than where they're currently at with 120 million bushels. So we could see export demand grow, but I think in tandem, import demand will come with it. As we kind of review the last year in exports, this is more just for your information, I would say. Phase 1 deal that we made with China, it was January 15, 2020. They agreed to buy $36.5 billion of U.S. ag products in 2020 and $43.5 billion of ag products in 2021. If we were conducting this meeting last year, you would have been listening to an analyst probably. I would have been saying this as well. Tell you that there's no way we even come close to that number based on where we were in 2019. And the African swine fever situation where it was a year ago. But we got closer than I thought. We didn't reach 36.5 billion. We got to 27.3 billion in 2020, $15 billion in Q4 alone. So they really, really ramped it up in the last quarter of the year. it was 35% below the agreement, but it was up 65% from the last year. The takeaway that I would give to you, I guess, based on any type of trade deal that's made with China or anything related to China, I would say, they're always going to do what's in their own economic best interest. They're going to source commodities from the cheapest place throughout the world, regardless of what deal's in place. And it's a lot better practice, in my opinion, to take action on what China is actually doing and prices in China versus what they say or report to be the case that going on in China. None of us know how much corn China has, but we can see what the price is. So that doesn't lie. On top of the issues that are occurring in South America, which we read about on almost a daily basis, there's been production issues in Ukraine, which is typically a large corn exported to China. Their export forecast is down almost 6 million metric tons, according to the USDA, versus last year. I believe they set a export cap at 24 million metric tons. Their government did, and there's also some Russian wheat tariffs out there as well that we're dealing with. So in general, as we kind of start to add up all the bullish things throughout the globe, this is also contributing to the supported prices we're seeing. As we look at African swine fever, they do have an updated chart on here that shows the January number, but I like this chart better on the left because it shows kind of what happened during the year of 2020 versus 2019. So it shows number of sows in China in million head, and granted this data comes from China, so we got to take it with a little bit of grain of salt, but you can see that sow numbers rebounded very well throughout, kind of consistently throughout the last calendar year, and almost got back to the 5-year average. As you look at the right chart, that's the number of reported African swine fever cases that occurred in China by month. And remember, this started becoming an issue way back in 2018. We saw that really slow down here as of late, and it was very uncommon to hear about African swine fever. But just recently, we've started to see a resurgence of cases, and there's some new strains of African swine fever in China that I believe are kind of popping up as a result of illicit vaccine use. And although some of them are not as lethal as the original African swine fever, they do result in, I think, a lower number of healthy piglets being born. And if discovered, obviously, the pigs are euthanized, so it is essentially 100% lethal. But that's something we're going to want to watch definitely over the next few months here on whether that continues to grow and become a bigger issue. Because part of the reason that we're dealing with the tight supply situation, both domestically and globally today, is right here on this slide. It's how quickly China recovered their sow herd from African swine fever last year. So where are we going? Right now, I would say that over the next few weeks, all of I would say majority of the market's focus is going to be on South American weather. These charts, some of them are in a different language here, but it shows the top chart is harvest progress of soybeans in the largest producing state of monocrop. So, and then you have on the bottom there, bottom left, the corn planting of the second crop. And you can see that they're starting to pick up the pace, I would say. They're 67% complete as of last week, up from 52% the previous week. And although it's below the 80% average, I would say it's picking up throughout parts of Brazil. But they've had localized flooding issues that are causing some quality issues with the soybeans, I would say. Some bidding up of freight costs to get soybeans to port, and it's been just problematic, I would say. And as we look at the corn planting at 73% there, normally I think that's 91% on average. If that continues to get hindered in the coming weeks, you could start to see a case being built for the USDA to lower corn production in Brazil as a result. So There's going to be some quality issues with parts of the soybean crop in Brazil that we're going to be watching. On the right there, you've just got the same thing, but in a different state of Brazil. Same type of story. We're behind, and there's definitely premium built into the market, I would say, at the moment because of these issues that we're seeing in Brazil. In Argentina, it's a little bit different story. They're not really harvesting anything at the moment. The corn crop is poorly rated. I believe it's 25% good to excellent at the moment. The soybean crop's only 10% good to excellent. It's been too dry there. There's been some kind of on and off rains, I would say, and there is some rains. Are some rains being forecasted in kind of the 2-week time frame in Argentina, but that's been the case for a while now. They just haven't been realized. But I would say if those rains do start to pick up, conditions still have the opportunity to improve a little bit in Argentina, but we're kind of running out of time to turn things around there. So we could see the USDA lower, production estimates in Argentina in the coming months as well. And although you see, I think it's important to put things in perspective. All these issues that we just went over in Brazil and Argentina. It's important to note that Brazil's production is expected to be a record this year. They've overtaken the U.S. in terms of soybean production. Argentina is down, but Brazil is up by much more than Argentina is down this year, and the production coming out of South America is still an increase versus last year. As we start to look at kind of what's going on with Brazilian harvest and shipments out of Brazil, these maps I obtained from Twitter from Karen Braun, who's with Reuters, and if you don't follow her on Twitter, she's probably the one person I'd recommend you do. You got the February 12th on the left here. You've got February 19th on the right. You can see that the number of vessels carrying soybeans is starting to pick up. And then you've got the 26th of February 2021 on the right. And then I've got the previous year on the left. So you can see that kind of this, armada of ships exiting Brazil with soybeans bound for China was further along last year. I would say in 2 weeks, a lot of these vessels are going to start to land in China. At this point last year, they were probably already getting some soybeans in China, but it's coming. The Brazilian faucet is turned on here, and you can see that reflected in shipments as well. This first is the corn shipments. You can see that we're in a time frame right now throughout the spring and summer where South American corn shipments are really low. Argentine harvest will start to pick up in May and June, and we'll start to see those pick up out of South America. But we're in a time frame right now where we can kind of capitalize and continue with strong corn shipments. The North American ones are on the left, and the South American ones are on the right. I'd say this chart's a little more interesting. On the soybean side, you can see that our shipments of soybeans have virtually shut off here just in the last couple of weeks. We went from shipping a ton of soybeans out on a weekly basis to almost none, and that is typically the case from February through July. And you can see it in that same time, South American soybean shipments start to really, really pick up in a heavy way, and we're in that process right now. As we look at the prices, this price chart is a little difficult to see, because it kind of just gets a little close here with recent price history. But just want to illustrate kind of as you look back into the middle of this chart prior to when the trade deal was made. This is when punitive tariffs were in place on soybeans delivered into China. When those were eliminated, we became cheaper than Brazilian soybeans delivered into China, and that's really remained the case since then. And only recently have prices converged here, and it depends what day you look at it. But on certain days, Brazilian soybeans delivered into China are cheaper, and but we're very close. And I would say the gap as we move forward is going to widen, where Brazil becomes cheaper relative to the U.S. We've seen that happen a little bit here on the corn side of things. Right now, the cheapest source of corn for China is Argentina. If you just look at posted values, you can see the Gulf added the U.S. here, and this is all in dollars per bushel delivered into China with freight costs included. You got the PNW, you got Brazil, Ukraine, and Argentina, kind of the main players in the corn export world. The same thing for soybeans here. You can see that the Gulf and PNW prices are kind of on par with the main port in Brazil, Santos. And I expect, as I said, the Brazilian soybean prices to decrease relative to the U.S. In the coming weeks. As we look ahead, beyond South American weather and exports, at the end of this month, we have a prospective plantings report. And one of the things we always watch as we start to enter into this time frame where all the analysts are talking about acreage is the soybean to corn price ratio. So you just take new crop soybeans divided by corn, and that's what is shown on this chart. And just kind of a rule of thumb that I use is 2.4. When it's above 2.4, it's more economically favorable to plant soybeans. And you see that in the kind of crop economics on the right here as well, that the net cash return to a typical farmer is going to be higher for soybeans right now. The market is doing its job to try to incentivize soybean planting. Granted, we're going to see upticks in both corn and soybean planting this year. We need to. We definitely need an increase in soybean planting, and I'm going to walk through kind of why it's a little more difficult to dig ourselves out of the tight situation in soybeans than it is corn this upcoming season. But we do need to acknowledge the Ag Forum numbers that were released a little bit ago here. I'm not remembering the date exactly, but it was last month. I would say nothing about the production side of the Ag Forum numbers was overly exciting or surprising to me. The demand numbers were, though. The main numbers that everyone's watching when Ag Forum puts out numbers are, planted acreage, yield, and then, they're going to put out a ending stocks number with some demand projections as well. And that's all displayed here on the far right of this table. And you can see that they're expecting 92 million acres of corn to be planted. Their trend line yield that they're plugging in right now is 179.5 bushel per acre. But in this type of situation, they are, even with these high prices, they're publishing a record demand number, total use above 15 billion bushels, basically matching up with production from the previous year and thus leaving our ending stocks number unchanged. So even with a record yield, and that might be record acreage as well, definitely record combined acreage between corn and soybeans. I don't think it's record on corn alone, but 92 million acres and a record yield, record production. They're projecting ending stocks to stay the same versus this last year. And I just don't know that that's really feasible when we're in the demand rationing price range that we currently are. I have to think that there's going to be some pressure on demand. Most notably, I think that ethanol number needs to come down a little bit, but pressure in other demand sectors as well that would cause that carryout to rise a little bit. And I'll show you my projections here in a second. But this chart just displays the corn prices on the line chart and then total demand in the bar chart. And you can see that when prices, granted this last year was a little atypical, but when prices start to rise into the demand rationing area where they currently are, I would say it's very uncommon to see huge demand increases like the Ag Forum numbers were projecting. They did the same thing on soybeans. Probably not as egregious in my opinion, but 90 million acres are expected to be planted by the USDA at this point of soybeans. The trend line yield they're plugging in is 50.8. They got total use at 4.5 billion, basically constant with this last year, and carryout growing just 25 million bushels up to 145 million bushels. I would say as well here that the chances to put those type of demand numbers together with the prices that we're at might be a little lofty at the moment. And I think a lot of analysts agree with my opinion on that, but it is the numbers, those are the numbers that the USDA is kind of going to be starting with in May. So it's, at least at this point, until we get the prospective planning numbers, we kind of have an idea of the starting point that the USDA is going to be dealing with in May. Same chart here that just shows kind of the unlikely nature to have demand this high with this high price. This shows just the combined acreage between corn and soybeans. On the far right, I have my current projection for planted acreage in corn and soybeans, 94 million acres of corn and 90 million acres of beans. And the two combined, whether you're looking at my estimate or the Ag Forum estimate, would be a record combined acreage between corn and soybeans, which has really trended higher since the early 90s as wheat acreage has trended lower with the huge increase in Russian production. Thought this chart was interesting as we kind of approach the end of the month and prospective planning estimates get put out for the actual estimates. Analysts will try to have a pre-report guess on what the USDA is going to publish. It's been very, very typical in recent years for the USDA or for analysts to overestimate soybean planting prior to that report. Not saying that that's going to happen this year, because I think if there was any year where they're not going to, hopefully it's this year with the incentives that are there for farmers to plant soybeans, but it is something to kind of keep an eye on. Lots of stuff here. You can kind of block out the left half of this chart here, and I do have the Ag Forum balance sheet there, and then I've got kind of three scenarios. I got what I believe to be the most likely balance sheet for 2021-22 crop year, a bullish scenario, and a bearish one. So as I stated earlier, I think we're going to plant 94 million acres of corn. I got my yield at 178. My total use is below what the Ag Forum has. It's at 14.875 billion. Carryout can grow up to 2 billion bushels with kind of 94 million acres of corn and a 178 yield, which is very normal in my opinion. So I think we can this summer kind of produce our way out of the corn deficit on the balance sheet. It's possible to get carryout north of 2 billion, definitely possible. On a bullish note, you could have acres as low as 89, production issue that causes yield to be down as low as 174, let's say. You're obviously going to ration some demand with that type of low production number, but I've got that plugged in at 14.3 billion. Carryout dips below 1.5 billion, and you're dealing with an average farm price in that situation probably in the high fours if we were to have another major issue. If we don't, the most likely scenario is we're facing an average farm price that's in the high $3 range. I got 375 plugged in here. It can dip as low as 340 if we were to plant 96 million acres of corn and 180 bushel per acre yield, record demand. Carryout could grow up to 2.2 billion. It's possible, not probable, but I would just say that a normal year and the acres that we're expecting at this point, it's possible to dig ourselves out of the hole, and there's definitely downside price risk as a result. If you look at the soybean balance sheet, it's a little more difficult. You got the Ag Forum numbers, fourth from the left there. You got what I have the same acreage number plugged in as them, about the same yield, a little bit lower demand. As I said, I think we're going to ration a little bit of demand if that was the case. And my carryout's, just north of 200 million bushels, and you're dealing with a high average farm price, 10.90 per bushel in that scenario. In a bullish scenario, acres as low as 85, yield as low as 47, rationing some demand down south of 4 billion bushels. Our carryout, projection is going to be right around the 120 million bushels that we're currently at, and the average farm price equilibrium, in my opinion, at that point would be around $13.50 a bushel. In a bearish situation, acres as high as 92 million, yield as high as 53, record demand or near record demand. Carryout could grow as high as 400 million bushels. It's possible, and you'd be facing an average cash price on the farm that's right around that 960 area in terms of equilibrium. So there's a lot of different, a wide range and possibilities that I just went through there for both corn and soybeans. But I think the takeaway is it's a little easier to produce your way out of this hole in corn. It's a little harder in soybeans, but it is possible. And in both cases, you have downside price risk. I think what we really need to do is just turn some of these millennial retail investors onto corn futures instead of GameStop. That's my game plan, and I'll be working on that on Twitter for you guys. As we look at kind of the current price situation, I just want to point this out to you guys. These are the crop insurance, the spring crop insurance prices in blue, and I've misspelled spring on my chart there. And in the gray, we have the fall crop insurance prices. And you can see that this is the highest spring crop insurance price, the February average that we've seen since 2014, 13, 12. You know, we're at levels at the moment that are worth protecting with crop insurance. I am not a crop insurance agent or an expert on it. You'll find as you're inquiring about it here, probably it's a little more expensive than you're used to. The same could be said for put options. But the nice thing about the crop insurance is it's going to be a cheaper way of protecting yourself than anything you could do, you know, with a put option because it's subsidized. I highly encourage you guys, if you have not looked into, you know, your crop insurance decision yet, I think that deadline is approaching in 5 days. I think you can make more of a case than you could for a lot of years to purchase crop insurance to protect, in most cases, I would say, very healthy profits per acre. As we look at the forward curve in corn and soybeans, I just want to reiterate, if you are holding on to any old crop corn or soybeans still, I'll pat you on the back. I definitely would not be at the moment, and obviously in hindsight you've done very well by doing so, but my general advice to you on old crop grain would be not to fight market structure. So you know, we tell the same things to our commercial clients when it comes to basis and spreads, but you know, the market right now is what we call an inverse. This chart shows the different futures levels from March of 21 all the way out to July of 22. You can see there's an inverse from March all the way into December, and then we start to see a slight carry built into the market in the new crop months. Not a big carry, but the market is telling you to let go of your old crop corn today, and it's going to give you less money for it tomorrow. And you can play this and continue to hold on to it and potentially be rewarded. But if you were to do so, maybe a less risky way would be to, you know, sell the grain and enter into a minimum price contract or buy a call option to have a finite amount of risk and upside potential that way. So you're seeing the same market structure really in soybeans and inverse all the way out into the summer of 2022. Don't let the prices that you're seeing in, you know, May and July futures prevent you from taking some action on new crop risk management, okay? Because it's that inverse doesn't have to go away. It doesn't have to go to a carrier or anything. It's very important that you're hedging your new crop risk in new crop months and not old crop months as well. One thing, just general comment I would make here as we enter into the contract part of this is that, you know, I think as we look at the margins that you guys are going to be able to lock in this year and realize at the farm level, there's a huge incentive right now to plant as many acres as possible. And none of us know, you know, generally what prices are going to do. You know, we can do our best to guess, and that's what we're paid to do. But I will say that if margins are good enough, you know, supply is going to increase. You're going to see that supply curve shift. And if demand stays the same, prices will decrease. You know, margins don't exist forever, and incentives are there to plant as much as possible and produce as much as possible globally right now. And just because we're in a tight situation today doesn't mean that we can't produce ourselves out of that situation. I like this quote. I don't think Mark Cuban was probably the first one to use it, but he says, pigs get fat, hogs get slaughtered. When you try to take it too far, people turn the other way. I'm just telling you, when you've got a good thing and you get greedy, it always, 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 always turns on you. That's rule number one of business. So try to keep that in the back of your mind as you're making marketing decisions about this upcoming crop. Some of my favorite charts to look at are long-term seasonals, and we're getting into kind of risk management part of the presentation here. This chart, and if you guys want a copy of this presentation afterwards, just reach out to your Landis account representative, and they can send you a PDF of this as well. But I like to look at these seasonal charts all the time. In general, the takeaway here is that prices trend lower from 30 months prior to you harvesting the crop to when you would actually harvest it, and usually the window of pricing opportunity at premium weather premium type levels during the growing season is a very short-lived one, and one that's very emotional and difficult to take action during. And a lot of times opportunities are missed if you wait until this time frame to start selling your grain, or if you wait until the fall time frame. So last year obviously was a very, very atypical seasonal year. You can see it in the light blue here. We had pressure in a time in a time frame where you're usually adding in weather premium, and then we rallied the market counter seasonally into harvest, when typically we would see pressure on the market. So very difficult year to have a marketing plan and be frustrated by it, but don't let it stop you from kind of sticking to the book. Long term, it will pay off for you. And you can see that prices of Dec corn at the moment are at very, very good levels relative to recent price history. And you got 2022 on here as well, looking pretty good. This is more just an interesting thing to note, but price action thus far in corn and soybeans has mimicked that of 2008 very, very closely. I'm not saying that that's going to continue to be the case, but just something to keep an eye on if you're kind of a student of the market. Same thing in soybeans, less so a trend from low to high, but I just want to kind of highlight, we're at really, really good price levels right now, even after today's pressure where we, failed to feed the bull yesterday. Still at very, very good price levels to kind of start marketing new crop grain if you have not done that yet in soybeans. And the same pattern really being followed in the November soybean contract with 2008. So you can see in both those years we did finish up lower at the harvest time frame as well. So quick little look here. I won't spend a ton of time on this, but this just shows the amount of time that Dec corn spends at certain price levels, and where we currently are. I would say there's only about 22 or around 22% of the days, all the way back to, I think it was a 15 years worth of price data. Over the last 15 years, we've only spent around 20% of the time above this level in Dec corn. And you have the same type of histogram there with the net fund or managed money position. You can see that they're, very, very close to record net longs. So we're at very good prices. Same thing with soybeans. You only spent about, I would say again, about 20% of the time, 25% of the time above these types of prices. And no beans over the last 15 years, and you got a really large net long as well that could decide to take some profits at some point. So we're going to talk about only one contract today, and then we'll get into questions. And I realize this is getting lengthy, but Landis, does offer a variety of different cash contracts to help you guys manage your price risk. And I encourage you to visit their website. They've got a nice little infographic here where you can kind of view contracts that fit certain market environments, or what your bias would be or goal would be with a grain contract. The one that we are going to walk through today is the averaging contract. And right here I have the details on that. Their pricing period on corn starts March 15th, 5 days from now. So if you guys are interested in enrolling bushels in an averaging contract, you need to do that right away on corn and contact your Landis account rep to do that. Basically how this works is we've got a period picked out that typically is a seasonally strong period to be making corn sales. And one thing I would say is that in a year like this year, where it's going to be even more difficult than ever to kind of time when you're making sales and how you're making sales, a really good way to spread that out and diversify your marketing plan is by using an averaging contract. It's just going to sell an equal number of bushels every day in between March 15th and July 9th. And I would encourage you to do some of this and see if you yourself with your other bushels can outperform the averaging contract. Last year was a tough year for an averaging contract, again, for reasons we already stated, very counter-seasonal pressure in the summer and rally in the fall and rally since the fall. But don't let that type of thing stop you from doing something that, on average, performs better than waiting until the fall time frame. You just have to commit 5,000 bushels, and the cost gets deducted off your basis at the end. It converts to a hedge to arrive at the end. You can make a decision to roll that if you wanted to at that point, but it's a good contract that spreads out your sales and helps you diversify how you're marketing your grain. And you can kind of do it and not worry about it. The same thing in soybeans. Our pricing window is a little different there. So the pricing begins April 19th and ends July 23rd. Just a better seasonal window that we picked out here for that. The minimum bushel commitment there is 2,500 bushels. Again, you're just selling an equal number of bushels in between the start and end date. And I think it has a role in everybody's marketing plan, every year. Why do I think an averaging contract is good? This chart here, I did not make it, so don't, thankfully we're not in person, so you can't throw rocks at me or anything, but this shows the typical seasonal price action in corn, and Iowa State put this together. And then it shows the typical seasonal corn marketings made by producers. So you can see that generally we're adding weather premium in the spring and early summer months, only to have it retracted out in the later part of the summer, and then we're facing some of the lowest prices usually in the fall time frame. And the farmer marketing habits, and granted I'm not saying this is everybody, but on average, we see the lowest amount of sales made by the farmer during the time when prices are at the highest level, and the highest number of sales made by farmers at the time frame when prices are at their lowest level in the fall. And I did a study that looks at this, the performance of this over time, and it does prove out. So in this example, there's 4 different ways that you could market your crop. One where you forward sell grain in June of the previous year, so it'd be like you were selling the crop you're about to plant as if you were selling it in June of last year. One is if you were to sell it on February of that crop year, so basically like you were to sell it Feb 1st, or February 1st of this last month. The other is using an averaging type contract, so it just takes the average price between February and June of that crop year, and then you have a spot harvest sale, so waiting until harvest. When you look at the performance of the different ways you could sell your grain, and this includes, years like last year and 2012 and 13, where we saw, late rallies that would hurt this. On average, using some type of forward marketing tactic, whether it's very early or doing it in February or doing kind of an averaging type contract, it's going to outperform making a spot harvest sale by roughly 30 cents on average, which I think is a pretty big deal in this business. So last year, you can see on the left there, was a very frustrating year to be a forward marketer, but on average over the last 13 years, it does work for you. Same thing in soybeans. I would say that the various ways that you could forward market a crop, including the averaging contract, 20 to 30 cents higher than a spot harvest sale on average. And if you're curious to know which years perform better, different ways, I do have these charts that you guys can take a peek at if you request the presentation on your own time, but we're not going to walk through those currently. Also not going to walk through the budget here, but this just shows Iowa State put together kind of a expected crop budget for this growing season, and you can see in the yellow here, we're looking at some really, really good net returns on corn on soybeans, soybeans, all the different various methods here. We're looking at really, really good net returns for you guys this year. So to recap, crop insurance is very important this year. Please ask your agent about it. Ask about some of the new products out there that allow you to protect a larger percentage of your crop. Continue to be proactive marketers rather than reactive. Don't let the current uncertainty of today's market prevent you from taking advantage of opportunities, because with uncertainty and volatility comes opportunity. Please continue to split up the way that you're selling your grain and the time frames in which you're doing that. And one of the really easy ways to do that is using an averaging contract on a percentage of your expected production. Remember that doing nothing equals risk, okay? If you're not hedging your crop or forward selling your crop, you do have risk. And then please continue to try to set sales targets based on break-even analysis and return on investment, and stick to them. A great way to do that is by utilizing offer contracts, which you guys can do through Landis. And if you aren't aware of those, please ask your Landis rep. So with that, I will open this up to questions at this point in time. And please enter those into the chat area if you guys have any. And we will try to address as many of those as we can. I know we've run pretty long here already. So if anybody does have any questions, please enter them into the chat portion. We won't, no one else will be able to see the questions. It's just us. So it's a nice anonymous way to address some of these. And we'll see if we have any of those.
Jake, under the questions tab, there is a few questions for you.
Okay. Send questions to staff.
I can read them to you.
Yeah, please.
If we have a good crop in 2021, are you bullish on DEES 22? Corn, I believe that you answered that in one of your slides, but if you wanted to go over that again.
Yeah, so the question was, if we have a good crop in 2021, am I bullish 2022? The answer would probably be no to that. If we have a good crop and we do see carryout recover in this upcoming growing season, I'm not saying there's going to be a ton of pressure on DEES 22 right away. And something that you'll notice as you look at some of the seasonal charts that I put together, this 30-month DEES corn one, right? So it's got 2022 on it. And you can see during the first half of this chart, you got 30 months from when you harvest it to when this chart begins, that volatility is lower. The prices do not move around as much in the first half of this chart. And I would say that if we have a good crop in 2021 and you end up seeing that red line trend lower into the harvest time frame, yes, you'll see some pressure on DEES 22. It won't be near as violent as you'll see in 2021, where the delta is going to be a lot higher. But we're at around 440 in DEES 22. It's a good level, to be honest with you, to start forward marketing the 2022 crop as well, in my opinion. Stacy, you got any more questions?
Another question that came in is, what do you think the real soybean carryout number is in regards to the earlier slide when you were talking about the stock to use ratio and not believing the USDA number was necessarily correct?
Gotcha. So the USDA currently has 120 million bushels plugged in as the current carryout. I realize as we look at this last year and the tendency for the USDA to go back and revise stocks in a historical fashion, which it used to be that WASDE reports, you get them on a monthly basis and they're important, right? But it was the stocks reports that kind of trued everything up. And I would say that when we're revising stocks in a historical fashion, that does become very frustrating, because then we just, what information is reliable, right? I think this last year with COVID made it a little bit more difficult for the USDA. Soybean stocks feel extremely tight to me right now. When you look throughout Iowa, I do not see a lot of commercial ownership of soybeans. I am bullish soybean basis. I am bullish soybean spreads. I am bullish soybean meal basis. I think it's going to be very, very difficult to source meal in the summer months in Iowa, especially. It feels really tight. I don't think the farmer owns a lot of beans at the moment, and I don't see a lot of commercial ownership of beans in Iowa. Now, granted, if you look at the CFTC numbers and the commitment of trader report, they would indicate there's a large net short held by somebody in soybeans that's hedging them, but I don't think it's in Iowa. So I'm pretty friendly to bean basis and spreads. As a result, as I stated earlier, you could make the case to increase soybean exports, I think, given the pace we're on and with both sales and inspections. However, if that does happen, the USDA at the same time is going to increase their import number to prevent that carryout from dropping below, much below where it currently is at 120 million bushels. Carryouts just, they cannot go negative. So if we start to see, a few more bean sales made and that number grow, we're going to end up importing bean from Brazil into the southern United States later this summer, if that's the case. And the USDA will do that on the balance sheet. They'll increase imports.
Next question is, do you think there's an increased chance of drought that will affect the overall crop production this year?
It's a great question. We didn't cover that. And I tend not to talk about long-term weather forecasts much in these meetings, because I just think they're so unreliable that a lot of people just waste a lot of time thinking about it. But I will say that the subsoil moisture is much lower as we head into spring this year, and the margin for error in terms of precip this summer is lower than normal. So yes, there is an increased risk of stress on the crop if we do experience a dry summer here. So yeah, I think that risk is heightened at the moment. I think the market's somewhat aware of that, though.
Any thoughts on the fiber market for feed, soybean hulls, wheat, in particular?
I'm getting out of my depth a little bit here, so I won't give you a real complex answer on this, but the feed market in general, I would say, DDG prices are very, very high. Meal prices are very, very high. There's a lot of corn being fed. I think there's a lot of feed alternatives that are being looked to, including wheat. And I think that's going to continue because DDGs will start to pick up a little bit. I think, the supply of DDGs and maybe put a little pressure on DDG prices as ethanol production starts to tick higher. As I stated, it's, about 80% of capacity right now. We're expecting it to ramp up higher here. But meal is going to be really, really expensive, I would say, throughout the majority of the summer. So there's a little bit of balancing act going on there, though, because there's in certain parts of Iowa, there's a lot of empty pig spaces right now. We had a lot of ISO weans that were killed this last summer because of the different supply chain issues that COVID caused. And we're seeing that play out now with empty pig spaces. So feed demand is decreasing a little bit in certain parts of Iowa to help offset the expensive input costs. But there's healthy margins to be had by livestock producers right now as well. So it's all cyclical, eventually production will increase enough to put pressure on prices and margins, and we'll go through the whole cycle again. But yeah, right now it's just the input costs are really high on the feed side, and I think protein's really expensive. So.
And one of the last ones is, what is your expectations on inputs prices for 2022?
Oh, you guys know the answer to this one. They're going to go higher, right? It's like clockwork, right? Your guys' expected net returns, as we showed with the Iowa State crop budget chart, are expected to be really good, and that in turn allows input suppliers to charge a little higher price usually, especially as demand for inputs increases, because as you look at the insurance prices this year and the new crop prices currently and kind of what we're all expecting, the incentives are there for farmers to throw everything they can at this crop to try to grow as big of a crop this year as possible. So the general demand for inputs helps increase prices, period, but then you just have less pressure on input suppliers when farmers are in a better economic situation, I would say. So we saw the same thing happen, in the years following 2012. So probably a similar pattern, I would say, to what happened back then.
And that is all the questions that I see.
Cool. Well, I appreciate everyone's time today, and those were very good questions. And as we pointed out at the beginning, I think a recording of this will be sent to everyone that was registered and posted on Landis social media. As I had stated earlier as well, if you'd like a copy of the presentation, please reach out to your Landis account representative. And if you have questions on any of the grain contracts that Landis offers and how they can help you with your grain marketing, including the averaging contract, which does have an upcoming deadline here 5 days from now on corn, please make sure you reach out to your Landis account rep. And appreciate everyone's time. And hopefully you guys gained some useful info here today that you can implement when making marketing decisions this summer. And good luck to everybody.
Thank you, Jake, so much for presenting. Thank you, everybody, for joining. And like Jake said, we will be sending out an email later today with the recording, as well as look for it on our social channel. So thank you, everyone.